Hello and Assalamualaikum. My name is Nur Amalina binti Baharo. I am from Diploma in International Trade. My match is number 057727. So today, I would like to present about my assignment on the subject Introduction to Finance, namely Ratio Analysis. So, in this assignment, I was assigned by my lecturer, Dr. Nazri, to analyze total of 8 ratios, namely, first, quick ratio, second, inventory turnover, third, debt to equity, fourth, debt to asset, fifth, return on equity, sixth, return on asset, seven, price per earning, and lastly, operating cash flow. So in this assignment, I have to analyze at least 2 companies under the wood and woods product sector. So I choose first Taan Hollis Berhad and second Hivya Berhad. So now I want to introduce about Taan Hollis Berhad. Okay, so the executive chairman is Dato' Ahmad Abdul Hamid bin Hadi Safawi and the chief executive director is Dato' Wong Kong Hiet. And Taan was headquartered in Cebu, Malaysia. Did you know in the mid-1890s, this company started from the humble beginning as a small trading company. Taan core businesses have expanded into logging operations and downstream timber processing and etc. In February 1977, Taan Hollis was incorporated as a holding company and listed in Bursa Malaysia on 23rd November 1999. And this company operates through timber product that include wood and wood product sector. And did you know that Taan Hollis Berhad has more than 7,000 staff right now. So that was amazing. They start from a small business into a big business. So we move to quick ratio analysis. Okay. The quick ratio is an indicator for a company's short-term liquidity position and measure a company's capacity to pay current liabilities without needing to sell its inventory or obtain additional financing. So basically, quick ratio, the formula is current asset minus inventory and divide by current asset. So, as the result, the quick ratio and plot graph, the company has a quick ratio of less than 1 from 2018 to 2020. This company may not able to fully pay off its current liabilities in the short term using its current asset. What can I say? The entity of this company is not financially healthy, and the risk to sell its inventory or obtain additional financing is high because of the quick ratio, not more than 1 but less than 1. So next, inventory turnover. So commonly, inventory turnover measures the activity or liquidity of a firm's inventory. So inventory turnover showing how many times the company has sold and replaced their inventory during a given period. So inventory turnover formula is COGS divided by ending inventory. So based on this graph, as you can see, 2020 show a very good improvement from the previous year. That is increase about 2 times from 3 to 3.25 times to 6.27 times. Okay. What can I see? Maybe this company has to sell the greater amounts to improve their inventory turnover. And I think to have the hard selling time is low because of their trend graph is still in good condition, and their inventory turnover is quite good, not so low and not so high. So I think it's good and average. The third ratio is debt to equity. So basically, debt to equity compares total liabilities to each shareholder equity, and can be used to evaluate how much leverage a company is using. The more high, the more risk. Okay, so the ratio is total liability divided by total equity. So as you can see, for the debt to equity, the unholders per height, look at the graph. Okay, from 2018 to 2019, in decrease, and then a bit 2019 to 2020, a bit increase. Okay, what can I say? This company is a bit higher risk to shareholder because when we look at this, this means the company has been aggressive in financing its growth with debt. Okay, so the risk to defaulting its debt is quite high because of the amount liabilities is higher than equity. Okay, so when you see this, the liabilities is half of the equity. So this is not good for the company, and the risk the company to be insolvent is high. So the ratio is not quite good. So previously we talked about debt to equity. So now we talk to debt to asset. So what is debt to asset? Debt to asset is basically a leverage ratio that indicates the percentage of assets that are being financing with debt. So the higher the ratio, the higher of financial risk. Okay, so the family is that to asset ratio is total liabilities over total assets. So based on my data, the Ta'al Hosberhad have a quite high total liabilities than their assets. So let me see the graph. Okay, the graph is from 2018 to 2019. Okay, in decrease, and 19 to 20 a little bit increase. Okay, so I can consider that is company is lower leverage because the ratio doesn't exceed 50%. Okay, previously that to equity, the ratio is at 50%. That shows not really good. Okay, so that to asset is good because it doesn't exceed 50%. Okay, this indicates it is considered a better sign of the financial stability of the company. Okay, so I think the company is less risky to invest and loans because they are less leverage. Okay. So the next ratio is return on equity. So return on equity is a measure of financial performance calculated by dividing net income to total equity. So ROE considered as a measure of the profitability of a corporation with stockholder equity. So based on the graph, we can see the ROE is quite low we can evaluate that the company is not efficient in utilizing the firm's equity. Alright, so from the graph, we can see that the ratio has quite low and unfavorable. This can be so risky to the investor out there because of the low returns in investment. As you can see on 2020, for every RM warranted the investment invest, they will only gain RM 0.04 at 9 cents. So this is very low, not so good. You still can invest, but it's all by your own risk. Okay. So the next ratio is return on asset. So what return on asset tell you? Okay. So this ratio basically measures the profitability of the total asset of the firms. So it's measure the relationship between net profits and total asset. The objective of ROA, find out how efficiently the total asset have been used by the management. Okay. So for ROA, we can see that for the holdings, this indicates the company generating fewer profits from its resources in the year 2019. Okay, as compared to 2018. Okay, as you can see, from 2018 to 19, a little bit decrease. So this means the management do not using the asset efficiently. So this indicates the company might have over-invested in asset and they fail to produce revenue growth. So what I can conclude, this will be a bit risky for investors to invest because of the low returns, right? Okay, so next, price per earning ratio, or also known as PE ratio. So PE ratio is commonly used to assess the owner's appraisal of share value. Okay, the PE ratio measures the amount of the investor are willing to pay for every RM of a firm's earning. The level of this indicates the degree of confidence that investors have in the firm's future performance. So, what I understand from PE ratio, the higher the PE ratio, the more expensive the company. Okay, so PE ratio, the formula is market price per share of common stock and divided by earning per share. Alright, so we can see based on the graph, Taan Khalis Berhad with the PE ratio around 50 to 29%. Okay. So based on the graph, we can see the stocks are going upward. So it's quite good. This means investors are willing to pay a bit higher for today's earning in anticipation of future growings. Okay, so the PE ratio in the average mode, because that is not so low and not too high. Okay, for me, it's good. It's good because the risk for investor is quite low because they are not paying too much. Okay, you know, because the higher the PE ratio, the more risk and the more expensive the company. So if the investor are willing to pay more, they gain more risk in financial. So lastly, ratio for the TAN Holdings Berhad is operating cash flow to sales. Okay, so operating cash flow is a measure of the amount of cash generated by a company normal business operation. So operating cash flow so important to a company, and it is so important to investors. Okay. So basically, operating cash flow indicates whether a company can generate efficient, positive cash flow to maintain the growth its operation, or otherwise it may require external financing for capital expansion. So the formula is operating cash flow divided by sales. Okay. Okay, so we can see the operating cash flow is between 15.69% to 26.01%. Okay, it's quite good. Okay, so we can see from this graph, this can indicate the company has the high ability to generate cash from its sales or turn its sales into cash. Okay. Okay, as you can see, 18 to 19 a bit decrease, 19 to 20 increase. Okay, so the sales of the company have been increased. Shows the It shows a good performance of to the firm. So the risk of this company is being insolvent is not too high because the trade receivable still effective management. So the management handle the operating cash flow in the good condition, and they manage efficiently, sufficiently, and good. So the risk of this company being insolvent is not too high. So my second company about wood and wood products is Hivya Bot Berhad. Okay. So the independent non-executive chairman is Sundamurti, and then the non-independent non-executive director is Belly Policarpio, and the executive director is Lee Yan Yong. Okay, before that, before Hivya Board listed in Bursa Malaysia in January 2005, I want to tell you about the past about Hivya Board Berhad. Okay, so before this, Hivya Board was incorporated in 1993 as a private limited company under the name of Hivya Board Sdn Berhad. Okay, and then the company converted into a public limited company in 2004 and assumed its present name. The name subsequently listed as Hivya Board Berhad. Okay, so Hivya Board Berhad operates under the wood and woods product sector. Okay. So, this company is headquartered in Gemas, Negeri Sembilan, Malaysia. Okay. So, a little bit about Hivya Board Berhad. They lead in manufacturing of particle board, okay, such as reconstitute wood panel derived from rubber wood residues, while its subsidiaries are involved in downstream particle board, base ready to assemble, furniture manufacturing, trading, and distribution of particle board and wood panel related products. And Hivya Board Berhad still produce product in various applications, such as including furniture components, and the inside speaker boxes, door manufacturing, office system, and DIY furniture components. So we move to ratio analysis. From the previous company, I have explained the meaning of the ratios. So I think no need to explain more about the ratio. So we start to the point, okay? Okay, for the Q ratio, here we are about. So what can I see? The Q ratio is about around 2, not exceed to 3. Okay, so based on the ratio and graph, I think the Q ratio is good because it's more than 1. Okay, so they have a financial health and able to pay their debt in short term without needing to sell their inventory or obtain any additional financing. So what can I see from this? On 2020, the quick ratio is 2.1. Okay, 2.1 that indicates that a company has RM 2 ringgit 10 cent of a liquid assets available to cover each RM 1 ringgit of its current liabilities. Okay, so this company do not have any problem in solving their debts in the short term. So they don't have any issues or problem to settle their debts, and the risk to have problems is very low because GK ratio is it 1. Okay. So we move to inventory turnover ratio. So based on what I understand, the high inventory turnover ratio, it shows the good sign for the company. But if it is too high, that is not good lah. Okay, so we can see from the inventory turnover ratios. Okay, what can I see from 2018, 2019, and 2020? It's leaving a rather negative impact. As it shows a decline from year to year. Okay. Maybe this company shows that sales are quite poor and may be experiencing poor management. Okay. So okay, I have calculate the average per year for inventory turnover. They only restock about 4.4 times a year. That shows a low turnover ratio, and the risk for companies having lower inventories is particularly high, following the downward graph from 2018 and 2020. Okay, so for the future performance, it also have a big risk, a high risk for the company. Okay, so can I say they have to improve their inventory management and increase their sales to make sure their inventory turnover ratio will be sustained and will be more high than this. Okay, next we move to debt to equity. Okay, what can I understand from debt to equity? How much you owe to other company, okay, and so on. So from the graph, we can see the increase and decrease of the ratio. Okay, so 2018, 19 increase. Okay, so I think it shows a positive effect on the company because if we see 2019 to 2020, it decreased a lot. Alright, so based on the data, we can say that this company have financially stable and the risk to have aggressive debt financing is low. because the debt doesn't exceed 50%. Okay, so as long it's below 50%, it's okay. Okay, so next is debt to asset. Okay, debt to asset is similar with debt to equity, but debt to equity divided by total equity, debt to asset divided by total asset. Okay, so based on the ratio that I have plot, okay, the asset ratio in the data signals a stable company with a lower proportion of debt. Okay, based on the data above, okay, I can see that this company can getting loans for a new project easily and more easier to them. Okay, because of debt to asset ratio is quite low and not too high, and the risk to be insolvent is low because the assets are higher than the debts. So next is return on equity. So basically return on equity, the more higher, that is a good sign to you. Okay, so return on equity is net income divided by total equity. So we look at the graph. Okay, ROE for this company is quite low and unfavorable. Okay, this company are not efficient when it comes to utilize investment to grow their business. We can see on 2020, we can interpret that every RM 1 ringgit of a common stock, common shareholders equity, they will earn RM 0.0369 only. RM 0.0369 cent only. Okay. So this is very risky for the investor to invest due, due to low returns and it's not worth to investing because you can still invest, but it is a big risk for you. Next is ROE. ROE basically it measures the effectiveness of management in generating profits. Okay, which is a valuable asset. Okay, so based on the graph, okay, I want to look at 2019. Okay, look at 2019. ROE is only 2.69. Okay, while the previous year, 2018, ROE 3.08%. Okay, we can say that in 2019, the performance is quite poor than the previous year in terms of efficiency using assets to generate revenue. Alright. However, on 2020, the ROE increased back to 3.01%. Okay, but this is very risky to invest in this company because of the low return on assets and low chance of profitability. So next is PE ratio, price per earning ratio. So the higher the ratio, the more expensive the company. But sometimes the higher the ratio, it becomes overvalue of the company. So it based on the situation and the sector of the company. Okay, so we straightforward to the graph. Okay, so we can interpret that okay, 2018 PE ratio is low, but 2019 and 2020 they increase. Okay, on 2020, I can say that the investors are willing to pay 25.36 times the EPS, earning per share, of this company for the share price. Okay, this indicates that investor will incur less risk by investing in this company because they pay not too much and not too high, not too much, and it's a I think that is an average ratio, and yeah, less risk for the investors. So the last ratio is operating cash flow to sales ratio. Okay, so what can I see from this? 2018, 19, and 20. Okay, so for the Hivya Berhad, they have poor operating cash flow. We jump into 2020, they only get 2.81% in operating cash flow. Okay, I think this company is at high risk, okay, of not able to pay its obligations of debt, and it can make its future more uncertain and can force down its share price. Okay, this is because operating cash flow ratio should be more higher because it is good for the company. But for the Hivya Berhad, they not, okay, they have low in operating cash flow. Okay, so this could suggest it is being paid mostly for its goods and services, or is managing receivables. Okay, so what can I say? The operating cash flow is at the high risk. Okay, so that's all from me now, Amalina. What can I conclude that the ratio that I have analyzed shows not so good and not so bad, because we know on 2019 to 2020, not only our country but the whole world have faced the problem that is COVID-19. Okay, so I hope on 2021 our economy is getting better and can grow efficiently, sufficiently. And yeah, that's all from me. Thank you.
Okay, Assalamualaikum and hi. My name is Alfazidio and my metric number is 057925 and I'm from Diploma in International Trade. Okay, today I would like to present about my assignment, Introduction to Finance, about ratio analysis. Okay, for this assignment, I need to analyze all the ratio. Okay, the first one is quick ratio. Second is inventory turnover, and the third one is debt to equity, fourth is debt to assets, and the next one is return on equity, return on asset, price per earning, and the last one is operating cash flow. Okay, so in this assignment I have to analyze at least two company under wood and wood products sector. Okay, so the first one I choose DITR3 Holding Berhad, and the second one is I choose Mentiga Corporation Berhad. Okay, so let me see the DITR3 Holding first. Okay, so Datuk Si Yong Wong is as a Chief Executive Officer at DITR3 Holdings, and He King Siu also become a Chief Financial Officer. Okay, so Jaya Tiasa Holding Berhad has been operating on 1 April 1916 and based in Cebu, Malaysia. Yeah, in Sarawak. Okay, so the Jaya Tiasa Holding Berhad is an investment holding company, operates an oil palm and timber producer in Malaysia. So it's operate through oil palm, oil mill, logs trading and manufacturing. Okay, so let me see the Mentiga Corporation Berhad. Okay, so Datuk Sri Diraja Haji Adnan bin Haji Yaakob is as a chairman. Tuan Haji Yaakob bin Sarani as a group managing director. So the company is based in Kuantan, Pahang and incorporated in 1970. Okay, so now I will explain about the quick ratio. Okay, but the first I want you all to know the left side is the Jaya Tiasa Holding Berhad and the right side is Mentiga Corporation. Okay, so the quick ratio is the ability of a company to use its near cash or quick asset to extinguish or settle its current liability immediately. Okay, so as you can see, we can say that the Jaya Tiasa quick ratio on 2019 the performance is poor than previous year in terms of efficiency using asset to generate revenue. However, on 2020, quick revenue was 0.9. So the quick ratio for this company was quite risky because of the low return on asset and chance profitability. Okay, compared to the Medica Corporation, on 2018, quick ratio is 0.42, while on 2019 is 0.47. So we can say that the quick ratio on 2019 performance is better than previous year, and on 2020 quick revenue was 0.55. So the company was not risky to invest because there is an increased return on asset and chance profitability a bit little. The second one is inventory turnover ratio. Inventory turnover ratio is showing how many times a company has sold and replaced inventory formula to calculate the day it take to sell the inventory on hand. Okay, so as we can see here, the Jaya Tiasa Berhad has been increasing from 2018 to 2020. The company was quite stable because they're having a good time to sell of their inventory to generate revenue. Okay, and also for the Mentiga Corporation, it also looks stable from 2018 to 2020, even though a little bit decreasing at 2020. But the inventory turnover ratio is as good as a company only restock their inventories 19.08 times a year on average. So this company is not risky for the firm because they are not having a hard time to sell off their inventory to generate revenue. Okay, so for the third one or the next one is debt to equity ratio. Okay, so the debt to equity ratio is a financial ratio indicating the relative proportion of shareholders' equity and debt used to finance a company's asset. Okay, so as we can see, The debt to equity ratio for this firm looks stable from 2018 to 2020, because decreasing is a sign of improvement. A lower debt to equity ratio will reduce the amount of average in the firm, which makes borrowing fund more easier. Okay, as we can see, even though have a, a little bit increasing from 2018 to 2019, 0.7 to 1.06, but it's not a too it's not a big problem for a company to resolve it. Same as the Mentiga Corporation, from 0.3, even though from 0.39 to 0.51 have increasing, but same is not the big problem for the each company to handle it. So this is my analysis for debt to equity ratio. Okay, so for the next one is debt to asset ratio. Okay, the debt to asset ratio is commonly used by creditors to determine the amount of debt in a company, the ability to repay its debt, and whether additional loans will be extended to the company. On the other hand, investors use the ratio to make sure the company is solvent, is able to meet current or future obligations, and can generate a return on their investment. Okay, so as we can see here, the Jayatiasa company, the debt to asset ratio has been increasing from 2018 to 2019, but decreased back on 2020. Is actually it shows a positive sign, but the debt to asset ratio on Mentiga Corporation shows a bad situation from 2019 to 2020, because the lower debt to asset ratio, the less debt is used to finance the asset in the firm. This lowered the risk of the firm defaulting its debt obligation, which is good for the firm and creditors. Okay, the fifth one is return on equity ratio, or we can call it as ROE. Okay, ROE is considered to the return on net asset and a measure of the profitability of a corporation in relation to stockholders' equity. Okay, so now as we can see, the Jayatiasa company is really is very bad, because already lost about 3 years. You can see here on 2018 is negative 1.49, on 2019 negative 22.49, and in the year of 2020, the return on equity increased back to a higher level, which is negative 0.01. So investing in this firm has a high risk of loss and low chance of profitability compared to the Mentiga Corporation. The return of this very also is not good, because profit become lower every year. From, as you can see, 2018 is 2.69 and 2020 become 0.44. Even it's still profit, but the profit is already decreased. So it's quite risky to invest in this company. Okay, the next one is return on asset ratio. Okay, so ROA is an indicator of how profitable a company is relative to its total asset. ROA gives a manager, investor, or analyst an idea as to how efficient a company management is at using its asset to generate earning. ROA is displayed as a percentage. The higher the ROA, is better. Okay, so on the left side is the company of the left side is very bad because of the lost profit. As you can see here, 2019 was a very bad year because 2019 is a very bad year because lost about negative 11.03. However, in the year 2020, the return on asset increased back higher, negative 3.38. Even it's still loss, but investing in this firm has very high risk of loss and low chance to get a profitability. Okay, compared to the Mentiga Corporation. Okay, Mentiga Corporation compared to Corporation also is is not too good because it's become lower every year. On 2020, it decreased badly until 0.32 from 1.92 on 2018. So investing in this firm also is quite a risk because of this decrease of profitable. Okay, for the next one is PE ratio at 31 December. Okay, so the PE means the price of the price to earning. Okay, so the PE ratio is used to evaluate how expensive a firm is. PE ratio also indicates the multiple of earnings an investor is willing to pay for one share of the company. Okay, so for the example, as you can see here, and on 2018 to 2019 has been increasing. This means investors are willing to pay more expensive price for one share of the company from year to year. Same also with the another one company from 2018 is 0.09, and for the on 2019 increased to 0.11, and on 2020 is increasing to 0.52. So uh, so this also willing to pay a more expensive price for one share of this company from year to year. But if you can see at Jayatiasa company from 19 on 2020 is decreased back to 0.22, so it's not a good year for this Jayatiasa company. Okay, for the last one is operating cash flow. Okay, the operating cash flow ratio is a measure of how regularly current liability are covered by the cash flows generated from a company's operation. This ratio can help gauge a company liquidity in the short term. Okay, so using cash flow as opposite to net income is considered a cleaner or more accurate measure since earnings are more easily manipulated. Okay, so for this firm, two of this firm graph, Jayatiasa and Mentiga Corporation, two of this company is quite stable level. This shows the company has an effective management of trade receivable because a healthy portion of their sales is on cash basis rather than credit. So about the risk of this company facing being insolvent is quite low due to a strong cash flow.
Evergreen Firebolt Berhad Ratio Analysis. For the quick ratio analysis, based on the graph, this company is not able to pay its current liabilities without selling their long-term assets during the year. On 2019, the company's quick ratio is slightly lower and thus not able to recover their current liabilities. This is very risky to the company because they cannot pay its debt in the short term. As you can see, their quick ratio for the 3 consecutive years are lower than 1. For the inventory turnover analysis, the company has weak sales for 3 consecutive years. Based on the graph, this company's inventory turnover ratio has rate of less than 4, means they may have excess inventory. What they can do is to decrease the average amount of inventory on hand. This is very risky to their company because they only restock their inventories about 3 times per year. Debt to equity ratio analysis. For this company, its debt to equity rates for 2018, 2019 and 2020 are less than 1, which means the portion of assets provided by stockholders is greater than the portion of assets provided by creditors. A low ratio, less than 1, is the great indication of greater protection to their money. The risk to be insolvent is quite low for this company because if you look at the graph, the company sustained to make sure the debt to equity ratio less than 1. Debt to asset ratio analysis. This company debts to asset ratio for 3 consecutive years are not more than 50%, which indicates that a greater portion of a company's asset is funded by equity. Any ratio that is higher than 1 would mean that they may have more debt than assets to cover it. The lower the debt to asset ratio, the less risky to the company. Return on equity ratio analysis. In 2019, return on equity ratio is negative 3.64%, while on the previous year, return on equity ratio is 1.36%. And in 2020, it dropped further to negative 9.63%. A falling return on equity may indicate a less efficient usage of equity capital. We can conclude that the company may be mismanaged and could be reinvesting earnings into unproductive assets. This is very risky to the company because of the lower returns and losses. Return on assets ratio analysis. From the graph, we can see that the ROA ratio are decreasing by years. For 2019, this company ROA is only negative 2.67%, and in 2020 it's on negative 6.8%, while the previous year 2018 it was 1.02%. We can say that the ROA for 2019 and 2020 performance are lacking than in 2018 in terms of efficiency using assets to generate revenue. The PE ratio analysis. In 2020, PE ratio is 18.13%, which is good because a higher PE ratio shows that investors are willing to pay a higher share price today because of growth expectations in the future. But in 2019 and 2020, the PE ratio dropped negative amount. The low PE might indicate that the current stock price is low relative to earnings. This is very risky to the investors if they still want to invest because they will only get losses. Operating cash flow to sales ratio. The company's operating cash flow for 3 consecutive years are not in good performance. This means that the company is not generating sufficient revenues from its core business operation and needs to generate additional positive cash flow from either financing or investment activities. This is very risky to the company if the company is still in this ratio because they can be insolvent. BTM Resources Berhad Ratio Analysis. Quick Ratio Analysis. Based on the graph, this company is not able to pay its current liabilities without selling their long-term assets during the year. In 2019, the company's quick ratio is slightly lower and also not able to cover their current liabilities. This is very risky to the company because they cannot pay its debt in short term. Inventory turnover ratio analysis. In 2018 and 2019, the company shows bad inventory turnover ratio due to bad sales and surplus inventory. However, in 2020, the inventory turnover increases. It is important to achieve high as it can reduce storage and other holding costs. Debt to equity ratio analysis. Based on the ratio, the company's debt to equity ratios are lower than 1, which indicates relatively safe. The company's portion of assets provided by shareholders are greater than the portion of assets provided by the creditors. A low ratio, less than 1, is the great indication of greater protection to their money. Debt to asset ratio analysis. This company debt to assets ratio for 3 years are below 50%, which indicates that a company has a greater portion of assets than liabilities. Any ratio that is higher than 50% would mean they have more debt than assets to cover it. This is not very risky to the company. Return on equity ratio analysis. From the ratio, we can know that this company's ratio are low for 3 consecutive years, which simply means that their business is not very efficient in generating profit. It is also not worth to invest in this company since the management is simply cannot make very good use of the investors' money. Return on assets ratio analysis. Based by the graph, 2020 return on assets is negative 10.37%, while the previous years are on negative 16.58% for 2019. From these ratios, we can say that the current performance is better in terms of efficiency using assets to generate revenue, but it is still low that the company is not able to make maximum use of its asset for getting more profits. The PE ratio analysis. From the ratio, we can know the company's PE ratios are low for 3 consecutive years and drop even further in 2020. The negative PE ratio means the company has negative earnings or is losing money. However, it doesn't mean that the company consistently shows a negative PE ratio is not run the risk of bankruptcy. Operating cash flows to sales ratio analysis. Looking at the company's OCF ratio, which are lower than 50%, which shows that the firm has not generated enough cash to cover its current liabilities. A low ratio could mean the company needs more capital.